Welcome. Come on in. It's Thursday and it's happy hour. Home happy hour to be exact. So grab a drink and let's get started. Hi everybody. It's Claire Paris with Paris Group Realty, LLC in Portland, Oregon. And today we're talking about assumable mortgages. So anyone under the age of 50 won't know what I'm talking about, but I'm going to explain it anyways because we might get there again. So back when I was a kid in the 80s, my parents were buying speculation homes, which are often called spec homes, meaning they were buying a house to fix it up and flip it. And those interest rates were typically at 18 to 24%. I don't know that we're ever going to see those kind of interest rates again, but if you could get a seller who had an existing loan, let's just say that seller had bought their home for $100,000 and they had $80,000 remaining on their loan, and their loan was at, say, 5% interest, but the interest rate that you could only get currently at that date and time was 7%. So you could say, hey seller, I'm going to go to your bank and qualify for that $80,000 that you have currently and take it over. And then whatever remaining I have to pay you would be at a higher interest rate, but it wouldn't be for the entire amount. This gets super complicated, but it's kind of fascinating because in essence, it's a lot like our jumbo loans today, which typically you would have a conventional loan. And the conventional loan limits right now are about $540,000 in Portland. If you want to get a loan that's higher than $540,000, you're typically going to get what's called a second mortgage. And that is going to be from $540,000 to X. Say it's $600,000. So my underlying loan is at a lower interest rate, might be around 3.5%, let's say. And then my remaining loan, that difference between $600,000 and $540,000, is going to be at a higher interest rate, say more like 5%. They combine the two payments to make your payment, but it's pretty common for people to want to pay that mortgage down that's at a higher interest rate and pay less on the mortgage that's at a lower interest rate. So that's a pretty common thing that people can do to get their payments way down. I don't know if we'll see assumable mortgages again, but it was only on underlying FHA loans and VA loans. Typically conventional loans could not be assumed. So back in the day, FHA loans were super popular for that reason. We'll see if it comes back. Thanks so much for tuning in to this week's Home Happy Hour. We'll see you next week. Cheers.